it can help to do a little analysis and see whether if you were to bring your spouse with you on your plan that you are selecting for to your business, maybe bringing your spouse to that on that plan and bundling it and bundling it with you and having him or her forego the plan that's the company is offering, that may result in tax saving. But of course, you have to look at it both ways to make the best decision. The other tax deduction that is often not taken advantage of by most taxpayers is the home office deduction. If you are using part of your house or your apartment, right? It doesn't have to be the whole room. Doesn't have to be the whole garage, or doesn't have to be the whole living room. It just has to be a portion of that room, but then it has to be exclusively used for that purpose, exclusively used and regularly used for business. Then that qualifies for home office deduction. And it is available for owners, from homeowners and renters alike. And you can take that deduction by two ways. The simplest, the easiest way, with that we call the regular deduction, will offer you $5 for each square foot. Let's say I am using a portion of my living room that is 10 by 10, right? That's about 100 square feet. So I will take that 100 square feet times $5, then that means $500 that I can take for deduction. So that is the standard method. The regular method is a little bit more complicated, right? Because it has an additional step, and that additional step will have me look at the ratio of that space compared to my whole house or apartment. Let's say I have an apartment that is 1,000 square feet, and the section of the living room that I'm using is 100 square feet, right? So when I take the ratio, 100 divided by 1,000, that's 10%. So with that 10%, I will go and calculate all my expenses that for running that house, whether it is the rent. If I am renting, I can take 10% of that annual rent as a deduction. If I'm a homeowner, I can take 10% of the mortgage interest, 10% of the repairs, 10% of the depreciation of the whole house. I can take 10% of all my utility bills. So that can add up very, very, very quickly if you or your tax preparer is making sure you are taking advantage of your home office deduction. The other important tax deduction that I will discuss is the Section 179. And it's a depreciation, right? Normally, the tax codes allow us, when we buy a capital asset. By capital asset, I'm referring to a piece of furniture, piece of equipment, piece of a computer. The tax laws tells us that you have to, if it's a computer, I have to depreciate it over 7 years, right? However, if I am in a year where my net income is high, I can choose the Section 179 depreciation. What that allows me to do is to take the whole cost of the asset as a deduction at one time in that year where I bought it, in that year where I put it into service, right? So as long as I put that computer in service by December 31st, I can deduct the whole cost of the asset in one time. Okay, so imagine how that can help with your net income. I mean, reducing your net income, therefore reducing the tax bill. The item that I can deduct using, that can depreciate using Section 179, it has to be a purchase asset. I cannot lease it, right? And I also have to use it at least 51% for business. So if I have an asset, a computer that I'm using for business and for personal, then I have to make sure I'm using it at least 51% of the time for business in order to qualify for Section 179 depreciation. And again, I have to put it into service, meaning start using it by December 31st. And to claim that deduction, your accountant, your CPA, has to put it on form 4562 so that it will flow to the net income. Now, Section 179 has some limitations, and those limitations are pretty high. And quite frankly, for real estate professionals, it may not be relevant at all. So I'm not going to spend much time on it. Then it has the max is 2,700,000, and if you go above that, there are some dollar-to-dollar reductions. And also there is a net income ceiling, meaning the tax laws will not allow you to use Section 179 to end up with a loss. For example, if you have your net income, right, total sales minus all expenses is 50,000 before you take the Section 179 deduction. If you go and purchase a piece of equipment or some nice piece of furniture to make your office look nice, and it's worth $60,000, you can only use Section 179 up to 50,000 because you have your net income is 50,000. You cannot take the whole 60,000 because you will end up showing a loss. So the IRS will tell, oh no, wait, you can take 50,000 this year. Will give you a net income of 0. The 10,000, however, you can take it next year as long as you have a net income of at least $10,000. So it's not lost, it's just reported to the following year. So this, a lot of people ask about it. How about the vehicles, right? This is pretty important because especially for small business owners. A few years ago, you could deduct the whole cost of the vehicle. For example, you can go buy a Range Rover for $100,000 and deduct the whole thing. But people, I mean, taxpayers has been abusing it so much that that loophole that used to be called the Hummer loophole or the SUV loophole has been closed down, meaning the IRS has put some restrictions as to how much you can take for that deduction. And for 2022, if it's a passenger vehicle, if it's a truck, it's a van, it's up to $18,200 for cars, right? And if it's an SUV, you can take up to $27,000 for that first year. However, there are some vehicles that could qualify for the whole thing. And those are the vehicles that are obviously not the ones that you will I will take to go out and hang out, right? Those will be vans that will be used to carry people to the hotel, to the airports, or vehicles that has no space or is not set up for anybody to sit in the back, or heavy construction equipment and so forth. So the laws has been tightened up in result of those abuses, but it is still a pretty healthy and pretty important tax deduction even for your vehicle. And here I'm just showing you guys how the IRS classifies those vehicles, the cars, the SUVs, and other vehicles. And now there is another type of accelerated depreciation that is called the bonus depreciation. And the Congress has decided to incentivize businesses to make large purchases, and for that purpose, us as the taxpayers, as business owners, we can use the bonus depreciation, which also allows for 100% of qualified purchases in the first year, in combination to Section 179. So these two combined are definitely very important tax break deductions that we need to keep in mind. Now, beside those depreciation, we can take also automobile expenses, right? Here we have two methods: the sample method or the standard method. If you are using the sample method, in 2022, the standard mileage is 58.5 cents per miles if you drove those miles between January 1st to June 30th, right? So if you had driven 10,000 miles during that period, then at 10,000 miles divided by 58 cents, 58.5 cents, that's about 5,850. I made a little error there. But if you have driven those miles between July 1st to December 31st, then it is 62.5 cents per mile. And that was in response to the hikes in gas prices that we all experience all over the country. Now, this is the sample method, right? Just the mileage times 58.5 cents or 62.5 cents. Now, the one that I call the complex method, just because you have to keep track of all the expenses, right? The gas, the car maintenance, the car repairs. Those are also deductible if you are using the business. If you are using the car for business 100% of the time, and if you are using it, let's say 50% for business and 50% for your own use, then it's only 50% of that you can deduct. Another tax saving strategy is planning for retirement. As a business owner, you may qualify to take deductions for contributions that you make to your retirement plan. And it is available to you. Either you are using a self-employment pension plan, or a traditional IRAs, or solo 401k. Now, this portion to form an S corporation, meaning choosing the entity that will allow you to reduce your taxes. This part of the tax law I love because it is powerful. It is powerful when it's used properly. It can really end up saving you a lot in taxes. Unfortunately, research has shown that about 80% of real estate agents report their income on a Schedule C on their 1040, meaning they have been taxed as proprietors, as a sole proprietorship, which means that you are paying 15.3% of self-employment taxes, and on top of your income tax, right? And to avoid that, the best thing to do is incorporate, right? Become, whether it's a PA, PL, or an LLC, and then making the S corporation, meaning you are going to the IRS. There's the IRS, I'm an LLC, I'm a PA, and I'm a PL, or at the state level. However, I want to be taxed as a small corporation, as an S corporation. So that, as I said, that will allow you to avoid the double taxation. And to do that, there are different steps that we recommend. It is crucial that you change your license with your real estate commission, so that your commission checks are not sent to you into your name, but in the name of the LLC or the PA or the PL, right? So you first set yourself up as a limited liability company, or a professional liability, a PL or a PA. Then you have to go to and get a tax ID for the business. That's we call an EIN for short. Then you go to the IRS and say, hey, IRS, again, I want to be taxed as a small corporation. And then you have to change your name. Yeah, I said up on the top, you change your name with your real estate state commission office to your name, so that the checks are not coming into your name anymore, but in the business name. And then you open up an account in the business name, so that the checks coming can be deposited. The commission checks may be deposited in the business checking account. And when you do this, now you have a corporation, right? It's not a company anymore, it is a corporation. And as a corporation, you, the owner, when you work for that business, you are an employee for that business, but you are also the owner. So as an owner, you receive a W-2 at the end of the year. You receive paychecks like any regular employee will do. And at the end of the year, you receive your W-2. Now, but also you are an owner because you are wearing two hats. You are an employee and the owner. So as an employee, you are receiving a W-2, which is taxed. That income is taxed. But then as an owner, you are taking distributions. And the beauty of this is that the distribution are not taxed. Those distributions are not taxed at all. And it is 100% legit. And that's the reason why people choose to elect to be taxed as an S corporation. Let's take a quick example. Again, as I said, if you are sole proprietorship, if you are filing your taxes you are filing taxes just by adding a Schedule C to your 1040, you are being taxed as a sole proprietorship. Therefore, you are subject to self-employment tax of 15.3% on top of your income tax. So you are being taxed again twice. So once you make that S corporation, what happened is that you can now break in your income into two, as I was saying. Part is a W-2 income, which we call a reasonable compensation, and I will explain that reasonable compensation a little bit in a minute, and the distribution that is not taxable. So let's take an example, maybe make it a little bit more tangible. Let's say you start your business year one, and you make 70,000 in profit, right? Net income less your expenses, you end up with 70,000 of net income. If you are a sole proprietorship, that 70,000 is taxed, all of it. But if you make the election to become or to be taxed as an S corporation, the 35,000, let's say the reasonable compensation is 35,000, right? The 35,000 will be taxed on a W-2, but the other 35,000 is not taxed at all. You take it home tax-free, right? Now, as you can imagine, there will be a tendency for people to put nothing, almost nothing, on the W-2 and put everything and take everything home as a distribution. And that's why the IRS came up with the concept of reasonable compensation. Reasonable compensation, it is really the value that the value of the services that you as the owner are rendering to your corporation. In other words, if you were to go and work for another company next door, doing exactly what you are doing for your corporation, how much do you think that will be worth, right? And so if it's 35,000, then that's no problem, right? You take the order 35,000 home. But if the calculations is done and the reasonable compensation is 50,000, then you can only take 20,000 home. And no need to say that the IRS is paying very, very close attention to S corporations because of that. However, if you determine, and today there are some computer programs that can allow us to determine the reasonable compensation, right? It will look into, okay, which part of the country it is. Obviously, if it's LA versus Florida, the reasonable compensation is going to be different, right? What do I do as a business owner for the business? If I'm only working there part-time, then my reasonable compensation will be different from somebody else's. So all those will be taken into account to come up with the reasonable compensation. So as long as you can determine, you can show the IRS how you got to that reasonable compensation, and it is backed up by those calculations, there is nothing to fear. You can become an S corp. You can make the choice to become an S corporation and take advantage of this powerful tax saving strategy. Now, I have a lot of real estate professionals, a lot of truckers come to my office and say, you know, I forgot to put some money aside to pay my taxes, so now I am in trouble with the IRS. So usually what I will tell them is this. Each time you get a commission check, right? Look at your tax rate at the bottom of your tax return from last year and multiply that commission check by the tax rate. Whatever it gives you, send it to the IRS as a prepayment toward your taxes. And this is a back of the envelope calculation, but at least it helps towards paying toward the tax bill for at the end of the year. So if despite all of that, a real estate professional or any 1099er gets into trouble, I put them to the tax resolution, to tax resolution work, and I help them with offering compromise, installment agreement, penalty abatement, or in case of innocent spouse relief, we help them solve their issues with the IRS. So just wanted to add this because I've seen it over and over, and that is some of the services that we offer as well at our firm. So that's all I had for you guys tonight, and I will be more than happy to answer any questions you might have tonight.
Okay, thank you very much
welcome.
for that video. So we have Sharonda. If I don't know if she has any questions or not, but Sharonda, do you have any questions?
No, I don't have any questions.
Okay,
Okay.
cool. Okay, well, for now, we're just gonna wrap everything up for the night. Or afternoon, depending on where everybody's at, evening.
I know,
Your information has been posted. I'm going to post it again. This will also be up on YouTube, all the other social media platforms. And thank you for sharing this information with us. And I would love to have you back as usual. So
sure.
Thank you for sure.
We'd love to. We'd love to. Thank you very much. And we'll talk to you guys later.
Okay, have a good one.
Thank you, you too.
All right, bye-bye.